The past few weeks have been a trying phase for equity markets globally as they have battled several headwinds, including the recent geopolitical conflict between Russia and Ukraine that has triggered a sharp rise in the prices of commodities, especially crude oil. Analysts say the fall was a knee-jerk reaction to the Russia-Ukraine conflict, and markets were likely to witness a choppy phase before discounting this development and staging a sharp rebound. Historically, equity markets have generally overreacted to geopolitical risks. Iran's invasion of Kuwait in 1990 triggered a sharp correction in markets and oil prices doubled. The equity markets, however, returned to the peak level 4 months later. The Kargil confrontation between India and Pakistan also saw a sharp correction in the markets in mid-1999. However, markets rallied sharply after realizing that this would be a short conflict. It is very evident here that markets typically react with heightened volatility on expectations of a negative event, and even when the event unfolds. But as events unfold over time, there is a realization that the situation might get diffused. The rally in equity markets then is much sharper. This time around, however, there are multiple moving parts that investors need to track. Outcome of the state elections, Life Insurance Corporation of India IPO, which may impact available liquidity, and possible rate hikes by global central banks, especially the US Fed. Yet, analysts are hopeful that the markets will recover their lost ground and trend higher after more clarity on how these events are progressing. Sunil Singhania, founder of Abacus Asset Managers, said, "We expect the Russia-Ukraine standoff to continue in some form or other, and one should closely track the developments. However, the investment decision has to be taken based on the fundamental and economic scenario both in India and globally. The worst seems to be discounted, and though we might not have a sharp V-shaped movement, markets should start to move into positive trajectory." The markets corrected sharply in February, with the S&P BSE Sensex and the Nifty 50 indices slipping around 5% each. The fall in the mid and small caps, which have lost over 6% and 10% respectively during this period, has been sharper, ACE equity data show. While the near-term scenario will continue to be choppy, analysts said that the current correction provided an interesting entry opportunity for long-term investors. However, they must be mindful of the inflationary impact on corporate earnings, which might see some pressure over the next few quarters, they cautioned. Let's go to G. Chokkalingam, founder and chief investment officer of Economics Research, to understand if the recovery, when it happens, will be sustainable or not.
Friday trade has proved already that it is, it has the ability to bounce back. But my point is that even if it bounces back, it may not be sustainable till March end. So, because the retail investors have lost a lot of money in IPOs and e-commerce companies. And secondly, in the first 9 months, a lot of people have made a lot of money in small cap and mid cap. So there will be a lot of loss booking also to reduce the overall capital gain tax. So the selling pressure also will come. And therefore, small and mid cap could be weak till March 4th week.
On Tuesday, markets will remain closed on account of Mahashivratri. On Wednesday, however, besides tracking global developments, markets in India will also react to the GDP data announced after market hours on Monday. Stock-specific action based on news flow is likely to continue.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.